Hey everyone, and welcome back to our monthly market commentary. My name is Brad Gotto, CEO and founder of Fiat Wealth Management. Here with me, as always, is Mr. Tim Holland, the Chief Investment Officer for TownSquare Orion. Tim, your time is always valuable. As we record this on April 7th,
Yeah, yeah.
even more valuable, I would argue. So I appreciate the time here today.
No, I appreciate the invite. It's always good to be with you, Brad. Hope you're doing well, and obviously a lot to talk about these days. Maybe more to
Yeah,
talk about than usual. So it's good to be with you for sure.
yeah. Family's good though.
Yeah, family's good. At the risk of oversharing, my son Spencer decided to ditch lacrosse for crew, so he's now doing
Which,
that.
if you're in the Midwest, by the way, that's a boat.
It's
Okay,
a
because
boat, yeah.
crewing, not that I know of, at least here in Minnesota, crewing is not an option for my kids in sports.
Yeah, and for what it's worth, where I grew up, there was not a lot of crewing either, but I guess that's what you want, right? Expanded opportunity set. Yeah, he's like, I'm not going to play lacrosse. I'm going to do crew. I said, buddy,
Yeah,
you've never even been in a boat before. What do you? He's like, I don't care. Let's give it a shot. And so far, so good. So that's been fun. That's a whole different world we've been exposed to, and
yeah,
so far, so good. How about your kids? How are they doing?
we're good. I'm ready for summer to be here. I actually had my
Yeah.
youngest out on the golf course yesterday. It was 60 degrees here now. Today it's like 30 something. Baseball's in full swing, and
Yep.
we're off to the races.
All right.
And so baseball's our busy season.
Yeah,
It's
for
going to be
sure.
good. But
A
I don't know if you knew this, Tim. There's a lot going on in the market.
lot going on.
So let's get to the meat of the conversation. If this is your first ever monthly market commentary, the way that Tim and I like to go about these is we're going to pick out one kind of data point from the last month, since we talked last, discuss that, kind of discuss an interesting point looking forward, and then find an interesting data point. So we'll look back, we'll look forward, an interesting data point worth discussing. Most of you could probably guess roughly where this conversation is going to go. But meaningful conversation nonetheless, because a lot has been written about what's been going on recently. I think we can add a lot of meaning to it, though, especially for the way that we do planning here at Fiat and the type of family that we help. And so excited to have you here. It's very timely, Tim.
Yeah.
And so let's start with that look back. You have to hang with me on this one just a second, okay? Because I always name
Yep.
these. I named this one Squirrel
Okay.
because that whole adage of like people that can't seem to keep attention, and I'm one of them, by the way. And there's always that joke going around that like you're sitting there focused on one thing and all of a sudden you go squirrel, and it's like your attention gets completely diverted. Here's
Yeah.
why. So now if you stuck with me on that, uh, everybody kind of thought when this new administration came in that the primary thing and kind of that early, new presidents coming in, left or right, doesn't matter, love to kind of get their feet hitting the ground running and kind of make a name for themselves right away and kind of get their administration moving. We kind of all thought regulatory relief and tax cuts, the extension of Trump's first term Tax Cuts and Jobs Act was going to be the major focus coming to the beginning of this year. Yet, here we sit, and the only thing he seems to be focused on is tariffs. So there's the new cuss word on Wall Street right now, the
Yeah.
T word, if you will. So let's talk a little bit about that. Why does he seem so focused there, and why is the market reacting as heavily as it is?
Yeah. No, I think you're absolutely right. A lot of folks, myself included, and so I've been wrong about this in the spirit of full disclosure, that the Trump 2.0 playbook would look a lot like Trump 1.0. To your point, tax cuts, deregulation, and then we'll get to trade, which is the order of the cadence from 8 years ago. Obviously, the president and his historical advisors have decided to go in a very different direction. The markets have been dealing with this focus on trade and tariffs for about 8 weeks, and that sort of added to some volatility after a great January. But we were still up nicely going into the end of March, and year to date, and off a little bit from our all-time highs. And obviously, April 2nd happened, the big announcement in the Rose Garden.
Yeah.
I won't sort of relitigate that because I'm sure folks know the news or what was announced, which is essentially a 10% baseline tariff on all countries as a jumping off point, and then reciprocal tariffs on about a 60 countries. And those numbers, I think, just came in way above what Wall Street expected. And so now you had that news, which hit the markets really hard on Thursday. Again, we're sitting here on Monday, the 7th. And then there was news out of China, I believe Thursday night, essentially saying we're going to retaliate with 34% tariff on U.S. imports. And then the market struggled again on Friday, and they've been quite volatile today. Last time I looked, they were off a little bit, not meaningfully. So, it's a cliche, but markets hate uncertainty. And as high as some of those tariff numbers were on Thursday, I think what Wall Street is struggling with now is this potential for a tit for tat escalation, unending escalation vis-a-vis the U.S. and other countries, their trading partners. And that means the certainty point that markets want to get to and adapt to keep moving out, if not indefinitely, for some time. And I think that's why folks are so stressed on Wall Street, and they're worried that the longer the uncertainty persists, the more likely we sort of talk ourselves into a recession, because businesses pull in spending, companies and consumers pull in spending. So at the risk of being absolutely useless today, I don't know when we're going to get to that point of certainty. Like everyone else, I'm hoping retaliation is limited from other countries, and you start to engage in more meaningful conversations. 2 points I would make. I would think there have already been meaningful conversations taking place between the U.S., the EU, Japan, China. We don't just sort of make an announcement, I think, like we did on Thursday, and then say, okay, let's talk. I mean, I think those conversations have been going on for a very long time. The other thing is, I think if things do get worse from an economic perspective, the economy, I think, was so strong coming into this period of meaningful uncertainty that even if we do stumble, any downturn does not have to be meaningful in nature. We can sort of unshackle the economy pretty quickly. And I just think the consumer and the corporate sector were in pretty good shape. So I'm hopeful that we're buying ourselves some time, because we were in such a good spot before things really got upended. So that's kind of where our thinking is. And again, I would expect some good news sooner than later, just because, to be honest, we've had so much bad news, at least relative to what Wall Street was expecting.
Yeah, I mean, what I hope people realize, and we've talked about this, I feel like multiple times in our commentary, Tim, is the markets are always future looking.
Yeah.
Right. And so the prices that you see today are the market's anticipation of what's coming tomorrow. Right. And they've just struck out. Right. Like they literally thought there was a fastball coming down the middle, and Trump threw a nasty breaker right in the dirt, and they look a little silly. And so we're seeing some of the reaction from that. I'm curious, and I'm going to put you on the spot here a little bit. If you don't have an answer, that's totally fine. But what is your anticipation of the long game that's trying to be played? I would assume there's got to be some sort of, even if it's a short-term game, but like, why are they, I think this is the biggest question, is why are they doing this? Because first of all, tariffs are not new. Okay. This is not a new thought process. It's not the first time the United States has done it. In fact, we get tariffed to death by other countries. Like, there are a lot of tariffs that we pay in trade already. So it's not like that we're imposing tariffs on other countries that have never imposed tariffs on us. Now, I can't speak for every country. I don't have it all memorized, all the tariff map. But again, this is a very normal game, so to speak, relatively speaking, in the trade, global world. That being said, why focus here? Why is this the game that they're choosing to play? And what is the outcome that you think that they're going after?
I lost you for a second there, Brad. I apologize. So my 2 cents is, and I don't know the president. I don't know his circle of advisors. I've never spoken to any of those folks about this or any other policy matter.
Yeah.
But the way I think about it is, and again, I could be way off base here. Let me back up. I'm personally very sympathetic to the argument that we deindustrialized our country the last 40 or 50 years. Now, I don't think it's as black and white as that, but I grew up in a city on the East Coast, and to be honest with you, there used to be factories there, and they're not there anymore, right? If you've ever been to Detroit or Cleveland or Youngstown or New England and the Rust Belt for sure. So I think the administration or Donald Trump, and he's been talking about this for a very long time. You can go back and watch some of these interviews he gave on TV in the 1980s. Thinks that. And again, I don't mean to put words in his mouth, I could be wrong, that broadly speaking, globalization, at least around manufacturing, has been a bad deal for the American worker and the American company. And we have essentially been treated unfairly. And one of the consequences from a trade perspective of being treated unfairly is that we've seen all these good paying manufacturing jobs, these good old fashioned, I don't mean that in a snarky kind of way, middle class American jobs that were so prevalent in the 50s and the 60s in particular, go overseas, maybe first to Mexico and then China and other countries. So I think that's what he thinks. And I've come to believe that in the last 4 weeks, thinking before that maybe that was part of it, but not all of it. So if I'm right about that, I think the tricky thing is, and I'm not being dismissive of towns that have been hit hard by factory closures over the years, I just think the world's changed so much that you can't really recreate that. Again, I'm very sympathetic to the argument where I grew up, what my friends did for a living, my dad's friends. I get it, but I just think that genie is out of the bottle and you can't put that genie back in. I do think for sure from a national security perspective, things around the aerospace and defense industry, antibiotics, critical healthcare supplies, I think we need to think about that from an onshoring point of view for sure. But, buying and selling goods, especially with friendly countries, has over time, if you believe sort of basic economic theory, everyone kind of gets richer. It's not a zero-sum game. But I think that's why we're here. I think if I'm right that you can't put that genie back in the bottle, the president probably knows that too because he's smarter than I am. And some deals will be struck to make the playing field more level. Because you're right, this isn't new, and other countries do tariff the heck out of us. And it's a reasonable conversation to have for sure. I just think the speed at which it's maybe moved and the severity of it has caught some people off guard for sure, and myself included. So that's how I'm thinking about it, if that makes sense.
Yeah. So to summarize all of that to the listener, number one, I used a baseball analogy, so I'm going to stick to it. And I got baseball in the brain because both my boys are starting their seasons here.
Yeah.
If you go to the playbook and you get used to what a pitcher is throwing, we thought he was going to throw tax cuts and regulatory relief and then throw in trade. And here he threw the fastball first instead of at the back of the bat. And on top of that, it was faster than we anticipated.
Yeah.
So it had more speed than we thought. And because we were caught off guard, the markets were caught off guard, we had a pretty precipitous response. That being said, let's take a look forward of what's coming. I'm going to name this point: when is bad good? This is a long shot with the ages of your kids. Have you seen the movie Wreck-It Ralph?
I have seen it. That we caught kind of the tail. I guess we caught that just in time. Maybe. Yeah. And it's what's the name? It's not. I always confuse C. Thomas Howell from the 80s. You talk about age now, sort of The Outsiders and Red Dawn and all that. Is it Thomas Riley or Thomas C. Riley? There's the voice, the guy from Step Brothers. Yeah, I always. Yeah. They don't look alike, but I always get those names.
The bad guy's basically going to AA meetings, trying to figure out how to be a good guy, right? The equivalent of an AA type meeting. So when is bad good? So what is coming out is basically that pessimism towards U.S. equities. The AAII Investor Sentiment Survey, that's a mouthful, okay? Just said for the last 4 weeks, the bearish readings have been above 57%. A first in its nearly 4-decade history. So for the last 4 weeks, the sentiment on the street has been more bearish or negative than it has in the last 40 years. Why is that? Why is that bad news? Or why is the majority of people thinking negatively possibly a good thing?
Yeah, right. So to quote someone from the Midwest, not the great state of Minnesota, but the great state of Nebraska, as Warren Buffett likes to say, be fearful when others are greedy and greedy when others are fearful, which is very hard to do because of our sort of emotional wiring, the way the synapses all fire and the fight or flight dynamic within all of us and how we've evolved. But I think one of the reasons why Buffett, besides doing this for 70 some odd years and being brilliant,
that little point
helps. You talk about compounding. I know he's worth like $150 billion, give or take. But and not that I wouldn't take $1 billion or $2 billion right off the bat, but like $100 billion of that 150 came like after the age 85 or something. So if you can kind of hang around long enough and let the markets work for you, good things happen. But I
Yep.
think a huge part of his success, I think, has been his ability to disconnect emotionally and just lean in when people are running the other way, because usually when everyone's running the other way, you have a bottom. So it's really hard to kind of, I think, make sense of this particular point in time. But people, I think, are very pessimistic about U.S. equities. Historically, when you hit that level of pessimism, the proverbial last seller is already sold, and you're closer
Yeah.
to a bottom than not. And so if there are a couple of things I would lean on personally to try and take comfort in right now, or put this point of time in context, it would be just the sheer amount of bearishness and the fact that, again, that the underlying economy was in really good shape coming into this. So between those two things, I think, who knows, but I think we'll be okay. But if history's any guide, the level of pessimism we're seeing right now has historically, knock on wood, in hindsight, marked, if not the bottom in risk assets, pretty darn close to it.
Yeah, there's just so many things you can study about history and the ebbs and flows of the market. And people love to study recessions and corrections and all that and try to gauge what caused it, what was going on at the time, when did things turn around, and obviously trying to use that data to make a meaningful stride forward the next time it happens.
Yeah.
One of the things that's very consistent in that we're discussing here is usually the average lay investor is the last person out.
Yep.
And it's when they capitulate or when they choose to start exiting markets that kind of signaled like, okay, if what was the terminology that they used a couple election cycles ago? Was it John Lunch Bucket? What did
I
they
think was it Joe Lunchbucket or John
Joe Lunch
Lunchbucket?
Bucket?
Yeah, I think it was.
So I'll use their terminology. When John Lunchbucket decides he can't take it anymore and he's
Yeah.
going to exit the markets, that's usually kind of a turning point.
Yeah.
That being said, I got an email from a buddy in the industry earlier today, and he put in there 95% of investment success is about doing nothing.
Yeah.
5% is about what you do when everyone else is going crazy.
Yeah.
And this is one of those times, right,
Yeah.
where
Yeah.
the news came so fast and so swift that markets reacted as such.
Yeah.
And a lot of the movement of the markets isn't necessarily based on long-term fundamentals,
No.
but based on fear of the unknown.
Yep.
And so the question becomes, can you hold tight during these times? I'll talk more about that here as we kind of wrap up, but I want to get to this next point, which is this data point worth discussing is recessed equals recession, right?
Yep.
And what I mean by that is we're assuming that when the Q1 GDP numbers come out, because they're not out yet, that there's going to be a pullback in our economy. There's going to be pullback in GDP.
Yep.
And a lot of people think that that's a math equation. That pullback automatically signals recession. Talk to me about that, and if it is that simple or that black and white.
Yeah. No. So I think you're right. So a couple things go into GDP. Considering the U.S. economy is somewhere around 31, 32 trillion in annual output, the formula, if the numbers are overwhelming, at least for me, the formula is pretty straightforward. It's personal consumption, business spending, government spending, and then net exports, right? And so if you run a trade deficit, it detracts from GDP. If you run a trade surplus, it's additive to GDP. So as you might imagine, companies in the U.S. listening to the new president talk maybe more stridently about trade and tariffs than a lot of us expected, again, expecting sort of the second term to look a lot like the first term, wanted to get ahead of potential tariffs and new tariffs. And so imports went through the roof in January and February. So our trade deficit right now is pretty much at all-time highs. It makes sense from a business point of view. If you can get something in to the country that you need to make your finished product and it costs $100 in January and you're worried it's going to cost $120 in June,
Yeah.
Let's do it now. So we probably will see a pretty meaningful negative number for Q1 GDP. I think that's terribly distorted by the trade impact, and again, sort of how tariffs got companies to speed up importation of goods.
Yep.
The shorthand definition, the back of the envelope definition for a recession is 2 consecutive quarters of negative GDP. So one quarter drop in GDP does not a recession make. The official definition is much more sort of comprehensive than that. There's an entity known as the National Bureau of Economic Research. They're the folks, they're academics and economists. They tell us when we've been in and out of recession. The tricky thing there is they usually only tell you you were in a recession long after you've exited a recession.
Yep.
So expect a negative number for Q1 GDP. I would, to a certain extent, put any major macro data over the last 30 days and over the coming 30 days and take it all with a huge grain of salt, because the conversation on trade and tariffs are upending all sorts of short-term spending decisions. Again, if we can start to get to some certainty around trade, especially with some of our bigger trading partners, I think things will settle down. I think the underlying economy is in pretty good shape. So if you see a negative number for Q1, it's not that you should dismiss it. I'm not saying you were going to, but I also would not be all that worried about it, because I do think it was driven by some one-off, again, tied to the trade and tariff conversation.
Yeah, it's gonna result in some great clickbait, though, right?
Oh,
It's
yeah.
gonna result in the ability for whoever wants to write them some pretty negative headlines around Q1 being negative, around the trade deficit actually widening in spite of, you know, these tariffs and things like that. Because of what you just talked about, it's important for the listeners to understand that that's kind of part and parcel of people going, hey, I'm gonna go buy something before the costs go up.
Yeah.
And so that's going to drive the timing of the numbers. And so pay attention to that. Tim, at the end of the day, there's just, anytime the market moves, kind of has this whipsaw movement like we've seen, it creates unease for people. And it's hard to let data flesh out. It's hard to let the economy flesh out. But for anybody that's gotten into our publicly traded markets in any meaningful way over a 20, 30, 40-year time frame, and then looks back, they've been so rewarded. It's unbelievable. Now, the counter to that that I hear a lot, working primarily with retirees, is I don't have 20, 30, or 40 years to kind of let this play out. But that's why, from a planning perspective, the only money that should necessarily be in equities is long-term money. And so, one, if you're a family that works with Fiat, know that we bucketed money based on timeframes. Know that we plan on this stuff happening. I use the analogy all the time, Tim, about the three little pigs. It's not a matter of if the big bad wolf comes, because he will. He's going to show up about a couple times every 10 years in a really meaningful way, maybe every 10, 20 years. So that's not in question. The question is, what'd you build your financial house out of? And when he shows up, is it gonna be blown over, or is it not? And so there's ways to build financial plans out of bricks. There's just ways to do it. And if you've done that and you've built a home out of bricks, anytime he actually shows up, there's ways to make lemonade out of the lemons that you've been given. And a couple examples for all of you out there, some positives that can come from kind of a whipsaw in the market like this, or having kind of correction territory as far as your portfolio being down in the moment, is to take advantage of things being on sale. One of the things that's on sale is your tax bill in your IRA. It's less today than it was a month ago. The opportunity for tax loss harvesting is out there. If you're of age, you have to take a required minimum distribution, or RMD, and you have to take it not because it needs to go into your life for spending, but you just got to take it to take it. Now is not a bad time to do it, because we can reinvest it in a different tax bucket and change the tax status of that money when it's a little bit cheaper. And at the end of the day, not all of your income, or hopefully your portfolio, is coming out of equities. As bad as some of these equities have been, there's been some bright spots in the market. And bright spots in portfolios if you've stayed well diversified, including the bond markets here in Q1. And so bottom line is, it's not all negative. And if you get online and you start paying attention to it, and these algorithms on social media are smart, they know if you click on one negative headline, they're going to give you another one, they're going to give you another one, and you can rabbit hole yourself into believing that the world's going to fall apart. But at the end of the day, if you're out there, the best thing you can do when everybody else is running away is run in. To quote Warren Buffett again, I'm going to have you give him the quote one more time, Tim.
So be fearful when others are greedy, and greedy when others are fearful. And right now, just about everyone's fearful.
Yeah. I would argue this is the number one value we can provide to the families that we work with, is to be your source of reason when times are crazy. And so please reach out. This is exactly what we're here for. That's why we're on retainer to all of our existing clients. If you're not a client of our firm and you're watching this and want to talk, please reach out to us. At the end of the day, this is where we earn our stripes, and our stripes are keeping the troops in battle when it looks like the battle can't be won. And so, Tim, greatly appreciate you being here as always. I'll be very curious to see what our monthly market update is going to look like come May.
Me too. Look forward to talking to you in May. Always great to be with you, Brad. Take care.
All right. Good to see you, Tim.
Good to see you.